A certificate of deposit, a CD, pays you more than a regular savings account. More interest, for the exact same dollars. And the bank does this for one reason. You promise to leave the money alone. That's the whole trade. You hand over a fixed amount, agree not to touch it for a set time, and the bank locks in a rate a little higher than your savings account pays. But here's the catch. Lock your money up for 5 years to grab that higher rate, and you can't touch a dollar of it for 5 years. Keep it liquid, and you earn less. It feels like you have to choose, higher rate or access to your cash. Except you don't. There's a simple, decades-old trick that gets you most of the long-term rate and frees up a chunk of your cash every single year, without betting your whole balance on one rate at one single moment. It's called a CD ladder. By the end of this video, you'll be able to build one in your head. Let's start with what a CD actually is. So, what exactly is a certificate of deposit? Forget the stuffy name. The cleanest way to think about it, you're renting your money to the bank. You hand the bank a chunk of cash and get a contract that locks in 3 things. And these 3 numbers are the entire deal. 1. The amount you're depositing. 2. The term, how long you agree to leave it, commonly 3 months to 5 years. And 3. The important one, the APY, the annual percentage yield, the interest rate, fixed for the entire term. It does not move. The deposit goes in, a padlock snaps shut, a fixed rate ticks out, and at maturity your principal comes back with the interest on top. In return for leaving it alone, the bank pays you a rate typically higher than a regular or even a high-yield savings account. Now, the safety. At a bank, CDs are FDIC insured. At a credit union, NCUA insured. Either way, you're covered up to $250,000 per depositor, per institution, per ownership category, a limit unchanged since 2008. Compare that to a plain savings account. Same insurance, but its rate floats. It can drift down next month with no warning. The CD's defining feature is that it doesn't. 3 numbers, locked. Now let's put the CD head-to-head with its main rival, the high-yield savings account, the HYSA, because the choice comes down to one clean trade-off. Picture a balance scale. On the CD side, the rate is fixed for the whole term, your money is locked, and if you pull it out before maturity, you trigger a penalty. In exchange, you usually earn a bit more. On the high-yield savings side, the rate is variable. It can rise or fall anytime. Your money is fully liquid, grab it any day. No penalty ever. The price for that freedom is you usually earn a bit less. So what tips the scale? What the money is for? The CD gets weight from a higher rate and rate certainty, you know exactly what you'll earn. Savings gets weight from access anytime. Plus the upside that if rates rise across the board, your savings rate floats up to follow, while the CD stays stuck where you locked it. To make it concrete, and these are illustrative example numbers, not live quotes, because rates change constantly. In early 2026, you might see a bank's best CDs roughly 3.5% to 4.1%, versus a top high-yield savings account around 4%. Close. The whole game is in the lock, not a giant rate gap. So the rule is simple. Your emergency fund, money you might need tomorrow, belongs somewhere liquid, like high-yield savings. But money tied to a goal with a known date, a down payment in 2 years, a tuition bill, can go into a CD that matures right on time. Here's where it all comes together, the ladder itself. This is the hero of the whole video, so picture it clearly. The problem we're solving is that trade-off from a moment ago. Lock everything long for the high rate and lose all access. Keep everything liquid and give up the rate. The ladder refuses to choose. It does both. Here's how you build one. Say you have $25,000 to put into CDs. Instead of dumping all of it into a single 5-year CD, you split it into 5 equal pieces. 5 rungs of $5,000 each, and open all 5 on the same day, at 5 different terms: 1 year, 2 years, 3 years, 4 years, and 5 years. Picture a staircase. The bottom rung is the 1-year CD, the next step up, the 2-year, then 3, 4, and at the top, the 5-year. And here's the nice part. Longer terms usually pay higher rates. So the upper rungs earn more, while the short bottom rungs give you near-term access. Now look at what you've built. Each rung is a step you can step off of, exactly 1 year apart. The 1 year matures first, then the 2 year, then the 3 year, and so on. One rung frees up every single year. But the whole ladder, taken together, is earning toward those higher long-term rates. And there's a quieter benefit. By spreading across 5 terms, you're not betting your whole $25,000 on one rate at one single moment. You've spread that bet across 5 years. Just remember, these dollar amounts are an illustrative example to show the shape, not a recommendation for you. So you've built the staircase. 5 rungs, one maturing each year. But here's the genius part. What turns a one-time setup into a machine that runs itself? What happens when each rung matures? Roll the clock forward. Year 1, your 1-year CD, the bottom rung, matures. The money is now free and liquid. You have a choice. Take that $5,000 and spend it if you need it. Or, and this is the move, reinvest it into a new 5-year CD at the top of the ladder. Year 2, the 2-year matures. Take it or roll it into another 5-year. Year 3, the 3-year, roll it. Year 4, the 4-year, roll it. And by year 5, the last original rung, the 5-year, matures, and you roll that one too. Now stop and look at what you're holding. After that ramp up, every single rung is a 5-year CD. 5 of them. But because you open them 1 year apart, exactly one matures every single year. You're now collecting the higher 5-year rate on your whole ladder, while still getting access to 1/5 of your money every year. The long-term rate and the annual access. That's the trick. And there's a bonus. Every time a rung matures and you reinvest, you lock in whatever the prevailing rate is at that moment. So if rates have risen, your ladder gradually captures those higher rates instead of being frozen at one moment forever. Fresh rates, fed in one rung at a time. Now let's be honest about the costs and the fine print, because there are a few real ones. First, the early withdrawal penalty. Break your promise, pull the money out before maturity, and the bank takes a bite out of your interest. The penalty is usually measured in months of interest, and it scales with the term, often around 3 months' worth on shorter CDs and 6 to 12 months' worth on a 5-year. It varies by bank, but federal law sets a floor. The minimum is 7 days simple interest, and there's no federal maximum. So a long CD you break early can sting. Then 4 caveats. 1. Inflation. Your rate is locked, but prices aren't. If inflation runs hotter than your locked APY, your money is growing but losing real-world buying power. That's real return risk. 2. You're locked in if rates rise. If the market jumps after you commit, your rungs are stuck at the old rate until they mature. 3. Watch for callable CDs. A callable CD lets the bank end the CD early. But you can't. It's a one-way door that favors the bank, so read the fine print. And 4. Taxes. CD interest is taxed every year as ordinary income, and if you earn $10 or more in a year, the bank reports it to the IRS on a form called a 1099 INT. The catch, even on a multi-year CD, you owe that tax annually before you can touch the money. None of this kills the CD ladder. It just means you go in with eyes open. Let's pull it together. A CD pays more than a savings account for one reason. You lock the money for a set term at a fixed rate. That's the trade, access for yield. The high-yield savings account is the opposite. Variable rate, fully liquid, no penalty. So emergency money stays liquid. Money with a known date can go into a CD. And the CD ladder is how you stop having to choose. You split your money across 1 to 5-year CDs, and as each rung matures, you roll it into a new 5-year CD. After the ramp-up, you hold 5 5-year CDs with one maturing every single year, earning close to long-term rates while a chunk frees up annually, and spreading your rate bet across time. Just remember the honest parts. Keep your emergency fund liquid, mind the penalty for breaking early, and know the interest is taxed yearly. This is educational, not financial advice, but now you understand the machine well enough to decide if it fits. If this finally made the CD ladder click, if you can now picture the staircase and the conveyor in your head, hit subscribe. That's the whole point of this channel. Taking the money mechanics nobody ever sat you down and explained, and making them obvious. And here's the perfect next step. All through this video we kept saying your emergency fund, Your liquid, reach-it-anytime money should not go in a CD. It belongs in a high-yield savings account. But what actually makes a savings account high-yield? And how much more does it really pay? Watch the high-yield savings video next, and you'll have the other half of this picture. I'll see you there.